Hello everyone and welcome to this training video with Forex Trading Signal. This is Ahmed Al Azaiza again speaking to you. In this video, we're gonna go to discuss the analysis and we're gonna go to discuss specifically the economy indicators. So we will be having in this video so many topics to talk about and we're gonna go to teach you and explain to you how you can trade economy indicators in a bit professional way. So what we are going to offer you now is the way of how to analyze and trade the economy indicators and how to combine them with the chart and how to make a trade out of the economy indicator readings and how you can merge that with the technical analysis and come up with a position or a profitable trade. I encourage you guys to focus on the chart and I encourage you to learn this properly and repeat this video several times so you can understand the concept. And I want you to focus not with me on the camera. I want you to focus on the chart and the slides so you can get the benefit out of it. So stay with us, please. We will start in a moment. All right, welcome back, guys. First thing we're gonna go to do, guys, we're gonna go to understand why US economy is so important globally. Then from that, we're gonna go to analyze the economy indicators and we're gonna go to know how to trade the economy indicators. So the first thing I'm going to explain to you, I want you to understand why US economy is so important globally and why it's so important to us. The first thing you have to understand that the US dollar is the safe haven currency. And why is that? Because the US dollar is the 80% of the total global trade. So what does it mean? That means that the US dollar used worldwide and the US dollar is globally used. So that means if all the countries are buying and selling goods and services, they're gonna go to pay by US dollar. And that transaction of US dollar is consists of 80% of global trade. So global trade is selling, buying between countries. So these countries, when they trade with each other, they pay by dollars. For example, if I want to buy gold from Australia, I'm going to pay by US dollar. If I want to buy oil from the Gulf states, I'm going to pay by US dollar. The second reason of why the US dollar is the safe haven currency that the US market or the US GDP, gross domestic product, is contributing on 25% of the global GDP. That means all the world GDP, all the world production producing US is having 25% out of it, and that is a huge amount. When you say one country is having 25% of the total globe production, that is a big amount. And when you say also that the US dollar is 80% from the global trade, that is also a big amount. And that is what makes the USD indicators strong. Now, those are the two facts which make the US dollar safe haven currency and make everyone in the world willing to have their money in US dollar. So that's why we call it safe haven currency. Now, let's go to the other direction. Now we have explained what does safe haven currency mean. Let's say, how does the economy of the US look like? So, Canada, Mexico, and China. Those are the main countries going to affect the USD when there is any indicator or any news related to those countries. If you realize recently, whatever is happening in China, we are immediately getting the effect on the prices of the Euro USD and the gold and so on. And if you realize that whenever there is indicator related to Canada, you got to see that the movement of the US index or the gold or the Canadian dollar or the euro dollar is significant. So that means those countries affecting the price of the US dollar and their currency prices against the US dollar. So the thing that I want you to know that US is exporting to Canada, Mexico and China, and whatever is happening with those countries, US is going to be affected as well. So vice versa, when it comes to the US importing from, so they are having the same country but other way around. So they start to import from China, then Mexico, then Canada. So that's why the trade war between China and America is big and having effect on the market. So just I want you to learn something from here that US exporting to Canada, Mexico, China, and those countries is going to affect the US if there is anything happening to their indicators. And US imports also from China first, then Mexico, then Canada. So if there is anything happening around these countries, US dollar will be affected. Now, those are the factors related to the global economy. Those are the factors which we need to consider when we trade Euro USD, Canadian USD, and when we trade gold. Now, let's move and understand how US economy works. So the reason why we are discussing the US economy because we said 80% from the transaction around the world globally is US dollar. So US dollar is the most used currency globally. So we need to make sure how does the US economy work because the US economy is going to affect 80% from our trade, which is the USD. So now if you look to the US dollar and you look to their important indicator, you will find the interest rate. And I'm going to detail for you the interest rate and how you can correlate it with the chart 100%. So stay with me and bear with me, please. So the tool they're gonna go to use to increase or decrease the value of the US dollar is the interest rate. The indicator they use to do that is the GDP, the employment, the personal consumer expenditure, the production price index, the CPI consumer price data, the PMI purchasing manager index, and the money supply in the market. So here there is two tools and there is almost like six indicators. So the indicators are the GDP, the employment, the PCE, and the PPI, CPI, BMI. The tools that the Federal Reserve Bank uses is the money supply and the interest rate. So they raise or decrease the interest rate or they bump money in the market by buying a bonds or they take the money from the market by selling their bonds. So I'm not going to explain what does GDP mean, what does employment mean, PCE mean, PPI mean, CPI mean, purchasing manager mean, because we have explained all those things in our videos, in the economy indicator videos. If you go to that playlist, I'm going to put it on this video toward the end. I'm going to put the full list of the indicator. We have explained all these indicators individually. Now it is the time to tell you how these indicators works together. So just from this slide, I want you to know that there is a six important indicators and there is two tools. I have the interest rate one and I have the money supply. So interest rate means when I increase the interest rate, I'm going to increase the value of the US dollar. Money supply mean when I purchase a government bonds, I'm going to give the government the money and I am going to take a bonds instead of it. Then the government will make factories and will start to employ people. They will raise GDP, they will raise employment, they will raise PCE, PPI, CPI, and PMI. All those will raise when there is a money in the market, and all those will shrink when there is no money in the market. So to take the money from the market and to bump the money on the market, we use the money supply and the interest rate. And we have spoken about these two tools, how they work when the Federal Reserve Bank use them. Now I'm going to tell you how does the interest rate affect the market, and I am going to give you a real example. So please bear with me and understand this and focus on this chart. Now, this is what you normally see with the Forex Factory website. You will see federal fund rate, but most of us we don't know what does it mean and what is happening when the interest rate goes up and what is happening when the interest rate goes down. So this is what I'm going to explain to you on the chart. So if you look here, we are in 17 September 2007. That is, if you remember, that is the financial crisis in 2007, 2008. And if you look here, this is on Monday, 5th September 2011. If I look to this trend line, I am going to see trend line is going up. So I want to understand what is the relation between the fund rate, the interest rate, and this trend line, which is going up for almost 4 years. And this is how I want you to learn how to trade. So now, 2007, 2011. Now, this is the interest rate on that period. This is the Federal Reserve Bank. If I come to September 2017, I'm going to find this rate. I'm going to find the rate was 4.75. And that is the area where the price has broken and started to go up. Why? Because the rate has reached maximum increase, and after that, after September 2007, the Federal Reserve Bank start to reduce the interest rate by 25 points. And that is where the price started to move up. And the Federal Reserve Bank in 2008 reached 25%, and he was holding that for the remaining 3 years until 2011. And based on that, when the Federal Reserve Bank hold it in 2011 for almost like 3 years, and he started to see economy indicator down, that is the time where the price has reached the maximum here and started to bounce back. So you can see, guys, this huge rally here, this huge trend, 4 or 5 years trend, it is because of the interest rate. By the way, this is the goal chart. So when we start to decrease the interest rate, you can see clearly that the chart is going up against the US dollar. What else you want? This is very good tool. Okay, so let's move now and see how does the interest rate affect the market in the second slide. I'm going to give you another example, and this is starting from February 2022 recently, and we are going to November 2022. So we are almost talking about 9 months. So let's see what has happened to the Federal Reserve Bank interest rate. So in January 2022, here in February, we started to see increase by 25 points. It was 25 and they have increased it to 25 points. So became 50. So that is the start of the increase. So when the central bank start to increase interest rate, that is where the prices started to go down, trend down. And that has happened in almost like 9 months. Now, in this area here, that is where the market started to anticipate that that is the maximum interest rate. Because you remember in 2007, the interest rate was maximum of 4.75, and that was the crisis scenario, and that is the recession. We call it recession scenario. We call the time when the Federal Reserve Bank start to cut interest rate to heat up the market. We call that recession. Okay. Now the market anticipating that that is the recession time, and the market is supporting and pushing the price up. So now, guys, if you correlate the technical analysis which we have taught you in our channel with the interest rate, you have it right. And you don't need to be too much genius about the interest rate. No, it is simple. Rate is reaching the maximum, started cut, you buy gold or sell the dollar index. Rate reached the bottom and started to increase, sell the gold and buy the dollar index and sell euro. Simple as that. But you want to know what is the maximum rate? What is the history about the rate? What is the maximum we can reach? Now, to understand what is the maximum we can reach, you might ask me, okay, in 2007, it was 4.75 maximum, but how is that is guaranteed? You got to follow and watch the central bank of America. You got to watch the Federal Reserve Bank. You got to watch the Mr. Jeremy Powell. He's speaking about that every day, and he's saying, I'm going to reach that level, I'm going to achieve that level, and this is how they see. Another thing, if you want to learn how does the interest rate is going to be stopped, you got to watch that six indicator, the GDP, the employment, the CPI, the PPI, the PCE, and we have all the videos how to watch them and how to protect them. So basically what the central bank he wants when there is an inflation going up, he want more unemployment so he can reduce the income. Then by doing that, by reducing the income, he gonna go to reduce spending. And by reducing the spending, he gonna go to reduce the GDP. And by reducing the GDP, there will be more unemployment people. Then everything will become cheap. Then the inflation will become down. And when we speak about that one, that is what we are speaking about. So, if I see now the interest rate at the maximum level, 5.5, interest rate for the US dollar. And I started to see unemployment rate increasing. That is an indication for me that the Federal Reserve Bank he gonna go to stop interest rate hike and he gonna go to start to fix it for 5 months. Then he will start to make interest rate cut, and that is the start of the recession. So this is how you're gonna go to trade interest rate and how you're gonna go to watch indicators. Now, in this slide, I'm going to explain to you what makes the US dollar cheap or expensive. So how the US dollar becoming cheap or expensive? First of all, we have spoken about the interest rate hikes. When I increase the interest rate, that will give the US dollar more value. When I increase the interest rate, I'm going to reduce the money from the market. For the people who doesn't know what does that means, if I ask you to open a small grocery and I give you $10,000 and I tell you go and open a small grocery shop, you're gonna go to open it, you're gonna go to put chocolate, chips, whatever you like to put on that grocery, and you will start to have income. Let's say that your income on the $10,000 monthly is $300. So now, instead, if the Federal Reserve Bank give you a $500 on that $10,000 and he say for you, give me that $10,000 and I'm going to give you interest rate of $500 every month. So which one you will go? Course, you will go with the $500 from the Federal Reserve Bank because the grocery, it doesn't make that much. It makes only 300. So by doing this, by increasing the interest rate, the Federal Reserve Bank is going to give you additional interest rate on your deposit in the bank. So what you're gonna go to do, you're gonna go to sell your grocery. You have a 3-4 employment. You're gonna go to tell them bye-bye, no more grocery, I'm closing this grocery, I'm going to put my money in the bank. So you're gonna go to put your money in the bank, but you have terminated the 3 employment from your grocery. Now, by doing this, the central or the Federal Reserve Bank is withdrawing your money from the market. You are not trading, you are not buying and selling chocolate in your grocery, and you have terminated 3 persons having income and they have pulled your money from the market. So by raising the interest rate, you're gonna go to reduce the money from the market and you got to have more money demand. When you have more money demand because the company which you were buying from them a chocolate to sell in your grocery, now that income doesn't come from you because you sold your grocery and you are not buying any more chocolate and you are not selling. So that company, they need that money which you were paying for them. So that money will be demanded because their production will be less because you are spending also. Then this what will happen if I need money, if I need to sell my chocolate and I need instead of my chocolate as a company money, I am going to reduce the price of the chocolate to have the money. And that is what we call it money demand. So pull the money from the market, there will be increase on the money demand. Then if there is increase on the money demand, then small amount of money will become bigger value, will be having more value. So you see the effect of the interest rate hike. When I increase a rate on the currency, I'm going to reduce the money from the market. I'm going to have money demand. I'm going to have the value for that increase. The US dollar will be increased or the currency will be increased. So now, the result of that, the currency will become expensive. If I raise interest rate, the currency will become expensive. So vice versa, if I cut the interest rate, I'm going to have other way around. I'm going to increase the money in the market because I'm telling the people, if you keep your money in the bank, I'm going to take from you $500. Then there you will say, no, 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 I want my money back. Then, because you want to invest in your money and you want to grow your money, you're going to go to open the grocery again and you're going to go to employ the people and you're going to go to increase the money supply in the market. And that is how the money, when it's too much in the market, everything will become expensive and the money will be useless, low value. So the result of interest rate cut is the currency will become cheap. So hope that I have explained the interest rate properly for you guys. Now, why we need to monitor the other indicators. So if the interest rate will do that, why then I need to monitor all those indicators? Why I need to monitor the consumer price index, the employment, the purchasing manager index, gross domestic product, personal consumer expenditures, and the PPE, the producer price index. Why I need to monitor them? I need to monitor them because from the indicator, we can anticipate the rate value the central bank or the Federal Reserve Bank is going to put in the market or raise or decrease. Now, I want to explain to you something called the forward rate, but I don't think that will help us too much. But I want to explain to you for the sake of knowledge and experience and to get you everything around the indicators and how the investors they think about the money. I will not make it difficult. It's a mathematics a bit and it will sometimes confuse the people, but I will try to be simple in this sense. There is something called the forward rate. And what does the forward rate means? It is the expected exchange rate between two currencies in future point of time when there is interest rate for two currencies comparatively with two interest rate. So we are measuring the current spot rate for a certain pair and we are calculating each interest rate and we are calculating how much will be the rate, the forward rate in the future based on the interest rate hikes. So this is important, but this is important for the people they make long trade and for the people they have swap in their accounts. So let me give you an example, a famous example for the Euro USD, and guess or imagine that the Euro USD price is at $1.2. So now this is the basic currency, we call it, and this is the quotation currency. And this price means that if I want to take €1, I'm going to pay instead $1.20. So we say that the euro is the base currency in which the interest rate is 1. So let's assume that the interest rate for the euro is 1%. And we said that the euro is the base currency. And in this case, we have a pack of euros, and that is the amount of the interest rate for it. And let's say now that the USD, we call it the quotation currency, in which that the interest rate for it, let's assume that it is 2%, and you can see here that the interest rate back on the US dollar is bigger than the euro because simply the interest rate is bigger than the euro. Euro is 1%, interest rate on dollar it's 2%. However, we call the US dollar because it's on the right hand side, we call it the quotation currency because we are paying in dollar to take €1, and we call the euro is the base currency, and we call this rate is the spot rate. Now, let me explain to you this formula here. This formula will give me the future, the forward rate in the future if I am going to keep buying euro for 1 year based on the interest rate. that will give me this formula. So spot rate multiplied by 1 plus the interest rate for the quotation currency. So this is the spot rate. We'll put it here. And 1 plus the interest rate for the quotation currency, that is 1 plus 2%, divided by 1 plus the interest rate for the base currency, that is 1 plus 1%. If I want to see this example, it looks like this. This is the example which we have explained on the top here. I don't want to repeat this. It says, suppose that you want to calculate the forward rate for the Euro USD currency pair, and suppose that the price is $1.2, and the interest rate for the Eurozone is 1%, and the interest rate for the US dollar is 2%, and I am going to buy only $1, and I am going to have for each €1, I'm going to pay $1.2. So calculate the forward rate. So to calculate the forward rate, I'm going to apply this formula. So $1.2 multiplied by 1 plus the quotation interest rate. This is the quotation interest rate, 2%, divided by 1 plus the base interest rate, which is 1%, and I will become with this forward rate. What does this mean? That means if I keep buying euro for 1 year, in the future, I am going to I'm going to achieve this rate. And that is why most of the company, they take a swap from you. They give you swap or they take from you swap. So if you work on a swap, you can sell or buy currency and work on swap and get a profit from the swap as well. But this is not to trade on it or to trade a swap. This is just to give you an example of the forward rate so you can understand what is the forward rate mean. So you can see here that the amount of dollar is shrinking and the amount of euro is increasing. So there is a fact here: when the interest rate for country A is smaller than the country B, country A will appreciate. So now coming back to the chart, when you see that a currency interest rate about to reach the maximum level, that's why the currency starts to go up, because the market anticipating and calculating the forward rate. However, I don't want you to calculate the forward rate. It's just for your knowledge and for your experience. And I felt like I need to explain this to you so you can understand what is happening in the market and what does the swap and why the people they take swap from you. And finally, guys, whatever I want to deliver for you, that you get to know interest rate limits and you get to trade with the interest rate. And I want you to know these indicators, and I want you to know also these two tools and these 6 indicators in this area. So we have two tools to be used by the central or the Federal Reserve Bank, and we have 6 indicators to watch. And all of those indicators and those tools, we have made videos for them. Please go and see them, and I'm going to put for you all the videos, all the list of the videos at the end of this video. Finally, guys, if you have enjoyed this video, if you have understood this video, if you see this video is good, please hit the like button, subscribe to our channel, share this content with your friend, and don't forget to activate the bell icon so you can see everything we produce in our channel whenever there is something new. Finally, guys, this is Ahmed Al-Aziz. I was speaking to you, and thank you very much for watching this, and see you in next training video.